A car doesn't need to be completely destroyed to be declared a total loss. In fact, many cars that still run and drive are written off every day. A total loss isn't about how bad a car looks, it's about math. Insurance companies compare the cost to repair a vehicle against its current value. Once repairs cross a certain percentage of that value, the car is no longer worth fixing in their eyes. That percentage varies, but the idea is always the same. If fixing the car costs too much, it becomes a liability instead of an asset. Repair costs aren't just parts and labor. They include time, rental coverage, storage, diagnostics, and potential risk if something goes wrong later. For normal cars, that threshold is harder to reach. Parts are common. Labor is cheaper. Repairs are predictable. For high-end and performance cars, it's different. Labor rates are higher. OEM parts are expensive and often back-ordered. Even minor damage can require extensive teardown and recalibration. Modern cars are packed with electronics, sensors, driver assistance systems, active suspension. After an accident, these systems must be restored perfectly. If they aren't, the car may not behave the way it was designed to. From an insurance perspective, that risk matters. Even if the car can be repaired, the question becomes whether it should be. That's why cars with relatively minor visible damage are sometimes written off. Not because they're beyond saving, but because the cost and risk no longer make sense on paper. For most owners, a total loss is the end of the road. The payout is issued and the car disappears from view. But for some people, that's where the story really begins. This is Apex Revival.